Could Vale be the hidden gem that every investor is searching for? Well, today we are going to go through our 7-step analysis process to figure that out, and all I can say is that it looks pretty promising. Vale is the world's largest producer of iron ore, a critical raw material for steel production. And they are also a leading global producer of nickel, a metal used in battery manufacturing for electric vehicles. All in all, Vale is one of the largest mining companies in the world, headquartered in Brazil. So let's take a closer look at it. If you invested $1,000 in this company 10 years ago, you bought 106 shares. And today, those shares would be worth something close to $1,065. So not a lot of growth. But Vale also pays dividends, and in that time you would get $788 as dividends. So if we add together the current value of shares and the dividends, we get $1,853. And that is a gain of 85% in 10 years. Not great, but not bad. So let's see who really believes in this company. Individual insiders, that is an X. As far as we know, individual insiders do not own any shares of this company. That is not encouraging because we like the management to have some skin in the game. But it is not the case here. And of course, insiders are also not buying. And do super investors own this company? That is a check. There is one super investor who put his money in this company, and it is Howard Marks. This position makes up 1.8% of his portfolio. And is he buying right now? That is an X. Last quarter, he sold over 4.5 million shares. And he has owned Vale almost non-stop since 2015. So what does he see in this company? Return on invested capital, that is an X at 8.1% 10-year median returns. And we want to see this number higher than 10%. So it's not bad, but below what we are looking for. And what do we know about net profit margin? It is a check averaging 22.2% over 5 years. And the industry median is 5.3%. So they are doing a great job at keeping the costs down. And now let's take a look at share buyback. It is a check. They bought back 17.1% of shares in the last 10 years. Very impressive. And the debt? It is a check. It would take close to 1.5 years to pay the long-term debt with a 5-year average free cash flow. And we want to see it under 2 years. We are using a 5-year average free cash flow and not the recent one because it is a very cyclical industry, and averaging things out creates a more realistic picture of the company. And how does this cyclicality impact Vale's growth? Revenue growth, that is an X at minus 1.1% 10-year compound annual growth rate. And because it is a cyclical company, this year it looks bad, but next year it may actually be extremely high. Therefore, we must be cautious when considering those growth rates. Free cash flow growth, that is a check at 12.3% in the last 10 years. And earnings per share growth, that is also a check at 32.5% in the last 10 years. And such result may be partially attributed to share buybacks. But there is another way to create value for shareholders besides buybacks. The dividend yield is 12.1%, so shareholders can expect to get $1.21 annually per every share. But also here we have to be very cautious. It is not a stable dividend. It changes all the time depending on the financial results of the company. So it looks like an incredible dividend yield, and it may be incredible, but it may also disappear at any moment. And the payout ratio, that is an X at 66.1%. And we want to see the payout ratio somewhere between 20 and 50%. So the recent dividend is actually more on the risky side. And what about dividend growth? It is a check at 27.6% 5-year growth rate. But when we look at the history of the dividend, we see how unpredictable it is. But we shouldn't just focus on dividends when making investment decisions. We should also consider buying companies only when the price is right. Price to earnings ratio is only 4.6. That is great. That indicates that Vale may be very cheap right now. And to calculate the intrinsic value of this company, we will use a discounted cash flow analysis. And as a starting point, we will not use the current free cash flow, but instead the 5-year average one, because it should give us a more realistic picture of this cyclical company. And if you would like to know how to value companies by yourself using 4 most commonly used valuation models, then head over to stockinvesting.academy and choose our company valuation course. Okay, so first we have to estimate the growth of Vale for the next 10 years. So in the low scenario, we'll estimate a decline of 3% for the first 5 years and then a decline of 1%. In the medium, 1% growth and then 2%. And in the high scenario, 2% and then 4% growth. So the low scenario shows a story in which Vale continues to decline. Medium is just below the predicted growth of the industry, which is 2%, and the high one is just over such growth. So in this scenario, they are growing faster than their peers. So with such estimates, the intrinsic value in the low scenario is $20, in the medium $27, and in the high scenario $30. But we have to always apply a margin of safety to those prices. I use a 30% one, but you can use any margin that makes you feel comfortable. And with such a margin, we get in the low scenario $14, in the medium $19, and in the high scenario $21. And the current price is around $10. So it is all in the green. Vale seems really cheap right now. But before we decide to invest our money into this company, let's try to put everything we learned into perspective. So we have here a company that is very nicely priced, that has a really interesting dividend, and that has some exceptional margins for this industry, thanks to its scale. On the other hand, we have to consider potential decline in iron ore prices that can be caused by lower demand for steel, especially in China. And this country is definitely the biggest customer of Vale. In 2022, China accounted for 62.9% of Vale's total sales volume of iron ore. And also, let's not forget about a cyclical nature of this industry, which makes such companies very unpredictable. But let's see, is Vale the best mining stock right now? Let's open our Stock Ranking Pro, which you can get access to by becoming a patron, and let's look only at mining companies. And let's sort them by the value difference. Well, it is definitely the cheapest mining stock out there at the moment. And when we look at the overall score, we see it is somewhere in the middle. But when we add the valuation to the equation, we see that even though it may not be the best mining company we ever analyzed, it looks like the best investment out of those companies. Well, let me know, what do you think? Is it the best mining stock right now? Or do you believe that the risk associated with a Brazilian company that is dependent in a meaningful way on its relationship with China is just too big?